Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today we have Ira Harris, independent trader, in the past a hedge fund manager, analyst, global macro consultant. Ira has been trading foreign currencies, bonds, commodities, and equities for 39 years. Also, he was a CME director from 1997 to 2003. Welcome, Ira.
Richard, nice to be back. It's another classic Wednesday with FRA. That's what I'm saying.
Okay, great. So let's look at your recent post. It's quite interesting. You look at global yield curves with a focus on Europe and Greece, and some of the danger signals coming out. Would you like to elaborate?
Well, as we have talked on this show many times, and going back when I first started doing these with Gordon Long, and in part of my analysis of global trends, I always look at yield curves because yield curves provide a great deal of information. And I know that everybody will out there say, well, bank stocks are going up because yield curves are steepening, or, everybody's got their spin. I have the scars on my back from being a practitioner of not only theoretically understanding, but actually put it into use. So when I've been wrong, I have paid dear prices. So my learning curve of the yield curves has been expensive over time. So
it's Peter Boockvar. I'm so sorry for being late.
Okay.
Oh, hi, Peter. Yeah, welcome.
I'm so sorry, Rich.
Oh, no worries. Yeah.
Hi, Ira.
Yeah, we got Ira. Yeah.
Peter, how you doing?
And so I guess, would you like to begin again, or from the beginning, or
Yeah,
maybe we just?
Yeah.
Okay, sure. Okay.
Yeah, we can begin.
I'm so sorry, guys.
Oh, no worries. Yeah.
Yes.
Glad you can join. So yeah, let's start. I'll do introductions, and then we can go into those topics. Peter, like what you've written recently, I've been talking with Ira about that as well.
Okay.
And Ira has written also some similar blog posts. Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Peter Boockvar, the Chief Market Analyst with the Lindsay Group and Co-Chief Investment Officer with Bookmark Advisors. Peter has a new newsletter product called the Book Report. That's BOOCKREPORT, and all one word. It offers great macroeconomic insight and perspective with lots of updates on economic indicators in the U.S. especially. And also we have Ira Harris, independent trader, in the past a hedge fund manager, analyst, global macro consultant. Ira's been trading foreign currencies, bonds, commodities, and equities for 39 years. Also, was a CME director from 1997 to 2003. Welcome, gentlemen.
Thanks, Rich.
Great.
Thanks, Richard.
And perhaps we begin with a discussion on global bonds. Both of you have written on what's happening in the bond market. Recently, your blog post, Ira, on global yield curves, and Peter, you've detailed what's happening between European and Japanese investors, net selling of global bonds. Ira, do you want to expand on your writing?
Yes. I was last night when I was going through and reviewing I look at them every day, 3 or 4 or 5 times a day off of Bloomberg. And I look at all the European yield curves, and I look at the U.S. yield curve and the Asian curves. And what has been going on in Europe, even with the ECB's aggressive QE program, is that the 210, and I'm only speaking the 210 here, because each yield curve, like in the U.S., a 530 has a far different character than the 210 does. And I say that the 210 is an investor curve and a 530 curve is much more speculative oriented. So they do have different characters. So I'm only speaking about the 210. I mean, we can go shorter, but this is just for the sake of the discussion.
Yep.
And those curves have been steepening out fairly dramatically. I mean, if you go back 4 or 5 months ago, the French 210 was probably around 95 basis points, maybe less. We're out to 165 basis points yesterday. The German curve is steepened too, and that's even with the ECB buy-in. So it's the short end that has stayed low, and people, I think, you know, as I talk about, that sophisticated investors and speculators are selling into the ECB buy-in part of the long end. You know, guys like Gunlach and Gross, these guys have all been out there talking about it, even though I think they make mistakes because not all debt is equal. They want to sell the Bund, and that's the last instrument I want to sell. But you see that they're steepening. Usually steepening curves, from my analysis, Peter may have a different view, have been usually not good for a currency in the short term, and certainly positive equity markets, because it reflects, steepening curves usually reflect that the economy is hotter than the central banks have prepared for, and people who need to hedge or are actually speculating will be selling the long end of the curve, going, well, economy's running hot, the central bank's been a little too loose. We just can't tell in today's world. It's not as clear and easy as it used to be. But one thing that did catch my mind throughout all of this is, number one, the Greek curve has inverted again, and significantly so. At the close of yesterday, the Greek 210 curve, even though, you know, there's not a whole lot of stuff in the 2-year, was a negative 200 basis points. And my point is that when those curves invert, it's sending a signal, and the signal is that the Greeks are having problems on the 2-year end, the shorter end of the curve. People are really nervous about the ability of the Greeks to make it through the next phase of the lending crisis. So that's what I wanted to pick up with that. So I'll leave the rest to Peter.
Yeah, no, I want to expand on that. I think it's a combination of things resulting in the steepening. Certainly Greece with their own issues, but we have seen some better European data. But also we've seen a rise in inflation expectations. The Draghi's favorite inflation number, the 5-year and euro inflation swap, has risen a lot over the past couple of months. We've seen German inflation that has now approaching 2% relative to the negative 40 basis point deposit rate. And we also know that the markets are sort of testing out the ECB, knowing that come April, their monthly purchases are going to be reduced by 25%. Now, granted, they're extending the term of QE, but on a flow basis, they're cutting it by 25%. So I think adding that all up helps to explain that steepness. And so you can pick apart, obviously it's good if it's responding to the growth. It's not good if it's responding to the inflation or the ECB backing off. So there is some good and bad within that.
And could also some of that be attributed to net selling by both European and Japanese investors, as you point out, Peter, you know, of global bonds in general?
Well, they've been selling mostly U.S. bonds. Europe's been buying less foreign bonds, so implying that they're buying less of their own bonds. But I think that Ira makes a good point, is that this is happening in the face of the ECB purchases. You know, the ECB, and I remember we talked about this last time, you know, the Germans are pissed. When they see inflation moving to the extent that they are, and the ECB that keeps on going, you know, full steam ahead, they're not happy about that. And the pressure is only going to grow as this year progresses, no matter the tough talk of Mario Draghi.
Yes, you know, and Peter picks up, that's absolutely a great point. And I'm sitting here, I received this from a very astute journalist at Bloomberg by the name of Alexandra Harris, who I'm a progenitor of. She sent me this because we were having this discussion. But the overnight deposits at the ECB, which yields you a whole negative 40 basis points, are at all-time highs. And the repo rate isn't moving in Europe. So you're having a dynamic there that is telling you people in Europe are very nervous because they're willing to give the ECB, the reserves, rather than going to the repo market and maybe repoing it on some Portuguese paper or something else, they want to park these reserves at the bank. So this is a really grave signal that investors are really getting nervous. And the amazing thing is the U.S. equity markets, the European equity markets are stalling out here. The U.S. market carries on like it won't affect them, but picking up where Peter was at, any of these problems are systemic in nature at this point. The ECB balance sheet is so big, the Target 2 funding is so big, the amount of debt, the sovereign debt purchased by all the domestic banks within the old established nation states are so vast that if this were to seize up, the repercussions will be felt globally. I'm amazed that this doesn't get any traction, which is why I bring up the Greek situation, because they're on the boil again too, and we haven't even discussed the elections coming up.
Could all of this cause international capital flows into the U.S. to increase in terms of going into U.S. assets and driving the U.S. dollar stronger? And then on top of that, as you mentioned, Ira, the border tax could be bullish on the U.S. dollar as well.
Well, you know what? I want to hear Peter's views on that, because I without talking to him, I won't surprise me, but about the border tax and the other capital flows. So I'm going to sit back and listen.
Well, it's possible in times of nervousness, as Ira said, that people repatriate money actually back home. And why else would you have negative record deposits where you're getting taxed 40 basis points? The Japanese, if they're worried about things going on overseas at home, they sometimes just repatriate and liquefy their balance sheets. So it's very easy to say, okay, I'll just send the money overseas, but it's not that easy because you have to hedge out your currency risk. Well, it's very expensive to hedge out your currency risk. So I'm not convinced that money is just going to find another home. Now, if it's U.S. money, well, yeah, U.S. money may leave Europe if there's a problem and come back to the U.S.
Yeah.
But European money that is not necessarily going to leave Europe, if they have their own liquidity and balance sheet issues, it's going to stay there.
Yeah, that's a great point. I agree with that totally. I think this gets ramped up in today's world where it spreads like, well, the safe haven trade is far different and doesn't play out the way most people think it plays out, because it's not one dimensional. It has, like Peter just said, it has so many different dimensions to it. And more importantly, it used to be, and Peter, I know will agree with this. I know this because if Japanese rates were 0 and U.S. rates were 5%, I'm talking about it on the short end of the curve, then the hedge is very easy. But to put on the hedge today is expensive because you're not earning any. There's no differential really, so all you're doing is you can't recoup that. So I think that point was really well taken, and it makes people more cautious.
And where does the effects of changes in the Dodd-Frank Act play into this, like in terms of effects on the bond market?
Richard, let me bring, because I want to hear Peter speak to this too, on that border tax, because my view on the border tax is these guys are looking at it wrong, only because when you're the reserve currency, this is not like Mexico putting a VAT tax on. When you're the world's reserve currency, the responsibility, and as Michael Pettis would say, it's a exorbitant burden, where as Giscard d'Estaing would say, it's an exorbitant privilege. But that locks you in, because if the U.S. were to put on that border tax, and first of all, I looked at the theoretical studies of this, how the dollar is going to rally 15 or 20%. If that were to take place, I believe the hit to the global financial system would bring on a wave of, I don't want to say disinflation, but deflationary liquidation of assets that could really wreak havoc. So I'm not one who's going, oh, this is the greatest thing. I'd be more cautious here, but I want to hear Peter speak to that.
Yeah, I agree. And just to differentiate for the listeners, we have the border tax, which Trump has basically used as another form of a tariff. And we have the border adjustment tax, which is part of the Ryan Better Way tax plan that is being pushed by the House, and the administration seems to be behind it. So looking at the border adjustment tax, I agree with Ira. The main thesis behind it is, yes, okay, we're going to tax goods that are imported. We're not going to tax those that are exported, and importers don't worry because the dollar is going to rally 20%, which will offset the 20% tax, and everything will be fine. But overhauling the U.S. tax code on the corporate side and placing your chips on the direction of foreign currencies and the dollar, for anybody that's been involved in markets, knows how stupid that is. Maybe the dollar rallies, maybe it doesn't. Maybe it takes 3 years for the dollar to adjust. And in the meantime, you send the economy into recession because the price of goods rises to an extraordinary extent on an economy that's dependent on consumer spending. And you throw in the $10 trillion of dollar-denominated debt held by companies overseas. Well, they're going to get killed by the strength in the dollar. It is so potentially disruptive that I get the idea on paper, but we know in life things don't always work out that way. And here's another scenario. So the assumption is, okay, the dollar is going to immediately adjust. Well, what happens if the market thinks, okay, this border adjustment tax is hugely inflationary. Walmart's going to raise prices by 10%. Well, and if the Fed is going to drag their feet in raising interest rates, well, historically, that's actually bearish for a currency. So imagine if they implement this tax policy and the 20% border adjustment tax, and the dollar actually weakens. Then you will send the U.S. economy into a recession. So it's beyond me why they can't talk about maybe cuts in the spending to finance these tax cuts. Why can't they just cut the taxes and close a bunch of loophole deductions to somehow pay for this? It's border adjustment tax, and the rationale is, well, everyone else is doing it, so therefore we should do it. Well, it's not apples to apples because it's a tax on income as opposed to the VAT, which is a little different. I'm just shocked that it's gained this much traction. But it's modeled out in a certain way, and people are following models here, unfortunately.
Amen. And, and that's exactly right. And how it keeps playing out. Oh, and this is going to happen. And I keep scratching my head the more I read about it, and I go, no, I just don't see it in that. And again, the variable of being a reserve currency puts you in a far different position. You bear a burden, and you know what? And the world is bearing a burden. I know Bernanke and Yellen and Draghi love their counterfactual, but we are bearing a burden of QE. And what's his name? Rajan, who was
the Indian
central bank governor.
The Bank of India.
Yeah.
University of Chicago.
Yes.
That is so well when it started that you were wreaking havoc. And the havoc is, as Peter brought up, everybody was borrowing in dollars, cheap dollars. Well, when the dollars aren't so cheap and you don't have the hedges on, because everybody said, well, they're all hedged. No, they're not hedged. Foreign corporations who borrowed dollars said, what am I going to hedge for? It's ridiculous. Then my costs are going up and I'm not going to do this. They just took the dollars. And as long as it's been somewhat stable in the system, they can meet their dollar payments. But if the dollar were to rally, were to appreciate 15 or 20%, if these models are right, the debt load, and it's normal. Peter, what did you say? 10 billion? It's probably
there's 10 trillion of dollar-denominated debt owned by foreigners.
Yes.
Foreign companies and countries have 10 trillion of dollar-denominated debt.
Companies, yeah, exactly, yeah.
Yeah, it's companies, yeah.
Yeah, so, the fact that you think that everybody thinks this is just a smooth way. Yeah, we are so far away from seeing any of this, and the impacts of it are global. Because when you are the reserve currency, John Connolly, it's our dollar, but it's your problem.
Right.
Well, that was,
and that gets to the point is that the stock market is pricing in this a very clean tax reform. They just assume, okay, we'll cut the corporate tax rate, we'll cut a bunch of regulations. If it was only that easy, the regulation side, yeah, we'll see some of that, but to the extent that markets are hoping for, will have the economic impact on how to quantify that is very difficult. And I think people are just assuming a clean tax cut bill, but that's not what we're going to get. When you have as much debt as we have, there's an interest in Washington to pay for it. And for every dollar of tax cut, you unfortunately may have a dollar of tax increase. And it's like looking at one side of the balance sheet. Oh, wow, you have a lot of cash on the asset side. That's great. But people aren't looking at the debt side and liability side of the balance sheet. And I see a similar situation with how the market is viewing Trumponomics and tax reform. I don't think they're looking at the whole package here that Ryan is going to push.
And speaking of regulation, how does the changes to Dodd-Frank Act, the financial reform from the financial crisis, how would all that affect what we're talking here?
Well, it's tough to answer because we don't know to what extent. I mean, I still think banks will still have to hold a lot of capital. You know, hopefully we'll get some improvements here and there that would further incentivize banks to lend. That would be helpful. But in terms of having a dramatic impact on the U.S. economy, you still need a willing lender and a willing borrower, and that equation still doesn't change. Hopefully this will ease the ability to do that. We hope. I think of the Volcker rule as a big question mark, and how that's going to facilitate trading in a lot of different instruments where liquidity has dried up in a lot of different areas. Yeah. But in terms of fixing Dodd-Frank and making it have this dramatic impact on the U.S. economy, it'll certainly help, but I don't know how to quantify it.
Ira, your thoughts?
Yeah, you know, I've been I could say actually on the record, because I had an article published in 2002 in August in the Financial Times. I had a letter under the editor. I've always been a fan of Glass-Steagall because I thought it did well at what, you know, and I was opposed to the repeal. I thought it was a gigantic mistake, and I actually had the opportunity to discuss it in a private setting with Phil Graham, and I had asked him whether he had any sleepless nights when they imposed Graham Leach, and he said he did. So, and I'll tell you, it was one of the few things that I agreed with. I agreed with Donald Trump on a few things. One is stance on NATO, but when he persisted in getting the reinstitution of Glass-Steagall into the Republican platform, I said, that makes sense. Dodd-Frank's a joke. Honestly, it was written by Wall Street lobbyists. I can tell you, sitting up at the firm of with the initials S&C, they wrote the legislation. It was meant to be a burden on regional and small community banks because the big banks could deal with the regulation costs. They may not like it, but it's all part of doing business, and the smaller banks could never do it. To me, the fix is very simple. Go back to Glass-Steagall. And as far as the Volcker rule, and I understand what Paul Volcker was trying to get at. My sense is this. If you're a commercial bank, although it was interesting, I have to digress from it, Mnuchin's testimony addressed this because he made a comment that if you're a commercial bank, if you have FDIC insurance, then you know what? You should have to adhere to the Volcker rule. He said that in his Senate testimony. And I stood up and cheered because that's exactly right. The problem is, if you're a bank and you want to lever yourself up to 33 times on whether it's using your prime brokerage business or whatever else you're doing with it, then you know what? You have to reveal daily what your risk profile is, and you can't be, if you hit a certain risk level, you can't get FDIC insurance because that's where the key is. Why should we be bankrolling their debt and that they can borrow cheaply because they're in the FDIC pool? They should, like anybody else, pay commensurate value for the amount of risk that they're taking. This is not socialism. And I understand the way FDIC works. So let's go back to Glass-Steagall. Let's effectively change the FDIC. And to me, that's how easy. And to me, the best part of Glass-Steagall was this, is that it separated commercial banks from investment banks. And long before the repeal, investment banks served a great thing for the financial system. They were the fiduciary. Could you imagine during the subprime credit crisis that erupted the whole thing, that if I was a client of Goldman and they were an investment bank advising me and I said, I'm buying this crap, that they would let me? No. But when you broke down that barrier, not only were they not telling you not to buy it, they were selling it to you. So if you want a fiduciary in the system, let the investment banks be investment banks and act as a fiduciary. And I think that would clean up the whole thing. And we should have I'm not in favor of book burnings ever, but we could burn Dodd-Frank because it's a piece of garbage. And nothing tells me more than that is that Chris Dodd and Barney Frank both left after it was passed.
And I just want to add one thing, pick out one important point that Ira made, is that smaller banks have been the most burdened from Dodd-Frank. The bigger banks, well, they can afford to hire thousands and tens of thousands of compliance officers. It's the small banks that have really suffered, and hopefully they get the most relief from any changes.
Yeah.
Amen. Amen. And I'll tell you what, that's why I thought that Sheila Bair should have been the Secretary of Treasury. I really did.
Yeah, it would have been a great pick.
Yeah, but I thought Mnuchin actually, in his Senate testimony, I actually sat up and listened to that, and I said, wow, maybe I'm wrong about this. Maybe he actually, because I don't broad brush and say Goldman's bad. No, I don't. That's ridiculous. There's plenty of good people I know who worked at Goldman, and there's plenty of smart people, certainly. I'll remind Lloyd Blankfein that, yes, they do God's work, but I had to remind him that the story of Noah was also God's work. So, the great floods and destructions also come. So I'm not sure which level they want to take, but you can't broad brush anybody. I'm hopeful that Trump will actually, because he likes to talk about all his promises, he made a promise about Glass-Steagall. Glass-Steagall would remove a lot of the burden for the community banks. I think that should be, I even think Lizzie Warren could get behind that. I think they'd find common ground.
Probably about the only thing they'll find common ground on.
yeah, that's for sure. That's for sure.
Moving into consideration of changes and trends in monetary policy and fiscal policy. Peter, you've recently written that the Fed, or saying to the Fed, you are woefully behind the curve in terms of what is happening. Can you elaborate on those thoughts? And is that intentional by the Fed?
Well, it's certainly intentional. So let's take a step back. This March will be 8 years into this recovery. The stock market is at all-time record highs, has had this extraordinary run. And the Fed has the Fed funds rate at 0.625. Now, historically, that rate was 200 to 300 basis points above the rate of inflation. So let's call inflation right now, it's pretty much 2%. The Fed funds rate should be 4% in a normal world. Obviously, we're far from a normal world, but even just to get real interest rates back to zero, the Fed funds rate should be, let's say, even 1.5% to 2%. So in the 8th year of an economic expansion, the Fed believes that negative real interest rates is the right policy. I think it's extraordinarily dangerous. The Fed is afraid of their own shadow. I think they, maybe in the back of their mind, they feel like they've created this monster that they don't know now how to tame. That said, I do think that they're realizing that they are caught, and that if Trump is successful in creating faster growth through tax reform and regulatory relief, that if the economy all of a sudden is growing 2.5 to 3 in a labor market that is full employment based on some statistics, well, there's not much supply of on the economic side to meet potential and increase in demand, and that's going to be hugely inflationary, while they sit and twiddle their thumbs at 0.625. So I think that they actually may raise in March. The market's not set up for it. The Fed has shown in the 2 times that they did raise that they like to raise on the day of a press conference. Well, there's just 4. I know they would like to raise 3 times this year. I think they would like to raise 3 times for the next 3 years, which would get them to 3%. So if they don't raise in March, then they're sort of boxing themselves into raising each of the next press conference meetings. It would be much smarter if they had any instinct to raise in March, because that would then give them some flexibility on how to react on the final 3 press conference meetings. So prudence would say hike. The market is, it's like the boy who cried wolf. I have a friend I like to quote, it's the boy who cried rate. The market doesn't believe that the Fed is going to raise more than 2 times, because we haven't even fully priced in 2 rate hikes in the Fed funds futures market. But I think that Janet Yellen next week, when she gives her semi-annual testimony, could set the market up for the possibility of a March hike. Now, she may not. She's an uber dove, but I think that there is a possibility, because it would give themselves some flexibility. We just came off a good jobs report in terms of the establishment survey. Obviously, there were holes on the wage side and the household survey. But what happens if we get a good jobs report in early March? And what happens if tax reform soon comes to some sort of fruition? Well, does she want to be following the market, which will run away from her again? Or does she want to give herself some flexibility? And I think she's going to err on the side of giving herself some flexibility possibly next week.
Ira?
So beautifully said. There's really nothing. I mean, I agree totally with him. But the only thing I would add is when you look at Janet Yellen, and she is the uber dove, because she views herself as a labor economist as the great protector of the American wage earner. I believe that she would withstand. She would be happy to see wages be growing at 5 or 6%, and if rates went to 1%, and that would make her happy. But now she's caught in a conundrum, whether she's going to be the standard bearer of the Clinton wing of the Democratic Party, and she's this is what I believe, theoretical, I have no proof, but her and Lael Brainerd will sit there, and everybody says Brainerd's leaving. I don't think she's going anywhere, because they believe that they will defend what needs to be defended. But she's caught between her philosophical stance on the importance of wages and the American worker, and the fact that they've had no wage increases over the period of time, and her disdain for Donald Trump. So Peter's 100% right. I agree absolutely where we should be at 8-year, and you're not at. We have never gotten close to a real positive yield. At least in Japan, they had deflation, so when they were at 0, the real return on money was positive. We've never even come close to that, and yet they're not ready to move. So that would be the only thing I would add. It's again purely theoretical, but I think Peter's said it as well as you can say it, and he's 100% right.
What's the fallout of all we've discussed on short-term, medium-term on the financial markets, the equity markets, bond market, commodities?
The fallout in terms of what?
The trends, like where would you see the effects of all of this happening on the stock market, the bond market, and commodities?
Well, I keep saying that this year is going to be this tug of war between optimism on the fiscal side and the headwind of changes in interest rates and monetary policy. I believe we're in the last inning of this central bank experiment over the past 8 years. You have, like I said earlier, the ECB that's going to be trimming purchases by 25% in April. We have Japan that's now getting tested every single night now in their yield curve control. And granted, they've gotten back some control of the 10-year yield, but there was a night last week when it spiked to 15 basis points. And if you look at the 40-year yield in Japan, that yield's up to 1.06%. That yield was 7 basis points back in July. So I think that the monetary / central bank / interest rate headwind is going to be a major offset on the fiscal side and the optimism for Trumponomics. Now, in terms of markets, at least in the stock market, there's no room for error. Today, Investors Intelligence, the weekly survey that measures bulls and bears. Bulls are the highest since 2005, January 2005. We're at a 12-year high in the level of bulls. Bears are down to a level of about 17. There's a 46-point spread between bulls and bears. You're hard-pressed to think that we haven't priced in a lot of that good news. So I think that a lot of this year is going to be determined by central banks and interest rates, and less so Trumponomics.
Ira, your thoughts also?
Look, it's again, as we can laugh, we're coming to a Minsky moment. The market is so stabilized here, and usually I'd say, well, it's kind of halting here to go higher. I don't think so. And I've been fairly neutral to bullish throughout this because exactly what Peter's talked about, which is the central bank theoretical policy, which has kept money so low that you had to be searching out quality stocks that paid some dividends to at least have a chance. So I believe the fallout is going to be very interesting to watch. But let's take Peter's argument to where I think it's going to play out. And it gets interesting. There is Germany. Because Germany has a fairly robust economy, certainly relative to Europe, but they're doing well in many ways. We know that they have, by their own admission, 1.7% inflation. They have a 2-year note that right now is negative 80 basis points price because of its demand for high quality collateral and other things. Even their 5-year is substantially low. And let's see what happens to Germany. Germans who got badly burned in the .com because they had the newer market, which was all high tech companies, and they're not prone to borrowing money for speculative purposes. But if I was living in Germany right now, I would be borrowing money hand over fist to buy hard assets. And I don't care whether that's das Rheingeld, I don't care whether it's real estate. That's where it's going to be interesting to play out. The United States, to me, it's a played out game because, yeah, I know we're going to get some tax relief, which I'm all for. Yes, we're going to get some regulatory relief, but the market's already, to me, gone that way. But yes, real yields here are negative, but if the Fed gets on the warpath and decides that their disdain for Trump is greater than their respect for the American wage earner, well, you're going to be fighting that. And so Germany really becomes a very interesting place because that's where the arrogance of Draghi blows up and something happens there. But in the interim, if I'm a German citizen, if I'm an international investor, I'm looking at German assets. And especially because you've got a fairly cheap euro, not that it can't go cheaper, but on a relative basis, it's pretty, it's a good value to buy things that in Germany have to be way undervalued. I mean, I would be very careful in what I bought if something had appreciated immensely, but I would certainly be running around looking for hard assets in Germany because what else is going to happen? And at this point in time, they don't have control of their currency. So this has to just keep playing out.
Very interesting. That's all the time we have for today, but great insight as always, gentlemen. How can our listeners learn more about your work? Peter?
You can go to www.bookreport.com, BOOCK report.com, or you can check me out at bookmarkadvisors.com. First one is my newsletter. The second one is asset management business, and BOOKMARK advisors.com.
And Naira?
I'm just, notes from underground. If you go to iraharris.com and subscribe to Notes from Underground, I put out my blog. It's free. There's a lot of good interchange of ideas that go on. We've kind of kept out the trolls and whoever else would want to come because I won't answer them. It's non-political. If I attack somebody politically, it's because of a policy issue and not I don't, you know what? I'm like Deng Xiaoping. I don't care whether you're a Democrat or Republican, as long as you're good for the economy. That's all I care about. I don't care so whether you're a black cat or a white cat. I care not. Just catch mice.
Okay.
And that's the way we go. And again, I would say go out and buy the book, The Rotten Heart of Europe by Bernard Connolly. Every day that goes by, it becomes more and more important. And you can go it'll come directly to me, and I'll mail you your books. Go to the site, therottenheartofeurope.com, and I will send out any orders, and you can pay me after you receive the book. I don't care. I will get it out to you, and we'll figure out payment. But a very significant book, important for this time.
Great. Thank you very much, gentlemen. Thank you, Peter. Thank you, Ira.
Thanks, guys.
Peter, as always, pleasure.
Yeah, same here, Ira. Thanks so much. Thanks, Rich.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.